Hey, good evening, guys, and welcome to another episode of Market Talk with Tex. It is Monday, December 19, 2022. So here we are in Christmas week. Looks like Christmas actually falls on the weekend. So we should have a full week of trading this week, and then I think it's going to be observed Monday of next week. So the market will be closed next Monday. With that said, in today's episode, I just want to talk about where we are here in the market. We're continuing to see that weakness and that move to the downside as we look to fill this downside gap. And just kind of, give you my thoughts on where we are and what I might be looking forward to as we head into tomorrow and the rest of this week. So as always, guys, appreciate you tuning in, and let's roll the intro and get started. All right, guys, so welcome back. As I said, yes, we saw the weakness continuing today. We actually put in new lows and closed at new lows today. Let's hop over to the daily chart, because one of the things I want to touch on here is the importance of looking at multiple time frames, right? Now, of course, we look at this daily chart. It's super obvious. Here's the all-time high. We have respected this down. Well, we didn't quite touch it there, but we've respected this downtrend line really well throughout this bear market. Really nice move off of it. We tried to hold a higher low here. We came up, and this is the first time that we touched the trend line and then held a higher low and then came back up to it. Every time we touched the trend line here, we pretty much just rejected, pulled back, came up here, touched it, rejected, pulled back. So, I thought that was like the best chance for the bulls to see, a bit of a breakout, kind of trap some bears and see if we can get the move higher. But, Jerome Powell had to come in and just kind of spoil the party for the Christmas, for the Santa rally, I should say. So Santa rally's off, it seems, at this point, or rather it just kind of came early. I mean, I did get a decent swing trade throughout this area here, and I really can't complain about that. But man, I was really hoping to see if we could get a nice move over the trend line, and who knows where we could have gone from there. But it just just wasn't meant to be. The bears were just still very much in charge as we continue to see this bear market playing out in 2022. Now, one thing I do want to point out is obviously we had this gap here. You can see it very clearly on the daily chart. This was a gap up from the I believe it was the CPI numbers that came out in November. And it was a significant gap up and quite a nice momentum move off of that gap up right back up into the trend line. Now, when we look at this on the daily chart, we've clearly filled the gap, okay? But the importance of looking at other time frames can't be stated enough, because if we go down to the hourly chart, you can see that we actually haven't filled the gap, right? If you look at the hourly chart, the gap fills way down here at 37.61. Okay, so if you're just looking at the daily chart, you might have missed that little nuance there and wondered, why we are continuing lower if we fill the gap, if you're playing, a gap strategy or something like that. And it just goes to show that, we should be looking at all time frames, regardless if you trade that time frame or not. They all play an importance. Throughout my trading career, especially early on when I was learning, pretty much everyone emphasized the importance of the daily chart. And don't get me wrong, the daily chart is important, and I still do pay attention to the daily chart. But it's not the only time frame. There's a lot of institutional traders that pay more attention to the hourly chart. Okay, so really good example here of why we do want to be looking at that hourly chart, and just shows you that we still have a ways to go. In fact, we've only filled about half of this gap. If we go and throw a fib on here from the bottom of the gap to the top right here, you can see that we have we've touched the 618. We've touched the 618 right here, which is that magic fib number, and we actually closed today just over the 50%. So the fact that we have filled 50% of the gap is notable, because anytime we move inside of a gap, of course I'm looking to fill the whole gap, but 50% of the gap fill is always a psychological support level. So with that in mind, as I said, here's the gap up that we had from that CPI back in November. You can see how well that it has been respected. It continues to remain my line in the sand for the short. I do believe that as long as we stay under that, the short is still in play. But I do also think that if we start to see price moving, if we get some kind of a rally and we start to see price move over and confirm over the CPI gap here, in other words, we move back over that gap, that's definitely a long setup that I wouldn't be afraid to take. You've got very tight risk just underneath if we fall back inside the gap if you're wrong. But if we do hold over the gap, you got to put yourself in the shoes of other market participants. You could be in a situation where shorts are going to be forced to start liquidating their positions, and that can cause an accelerated move to the upside. In other words, a short squeeze. I'd be looking for a move back up to the 3,900. You got a nice psychological whole number there. And if things really start getting crazy, maybe a move up to 3,950, which is actually the gap down from the day following the FOMC from last week. I really wouldn't expect a move over 3,950. I think that would be about all I would look for it out of the move if we get it. But just keep in mind, this is probably going to be a lower volume week as we head into Christmas, especially towards the end of the week. And typically when you're, because typically a lot of the, the big money takes off early around Christmas and, kind of takes the rest of the year off. So we could see kind of lower volumes throughout the rest of this year. But it doesn't mean that the market's not going to move, and you can actually see some pretty outsized moves happen in a low volume environment simply because there's not as many market participants to obviously stop price, in other words. So if prices start moving higher and there's not as many people participating, or not, I should say there's not as many sellers participating to kind of provide that resistance to stop the price from moving higher, it could just really... it can move higher very quickly because there's just, again, not as many market participants to kind of stop it from moving higher. And then you get in a situation where it starts breaking through key levels. Dealers have to start hedging their position and cause forced buying, which can really further accelerate the move. It, of course, can work the other way, too. If we start breaking levels to the downside, and the dealers have to start hedging and it causes forced selling, and you can see accelerated moves to the downside. So just something to keep in mind, even though I'm kind of expecting a lower volume environment this week, especially as we move towards the end of the week. It doesn't mean that we can't see some outsized moves. Now, if we do see a relief rally up into 3,900, maybe even 3,950, I really don't think we'd go any higher. And why do I think that? I mean, we want to look at these charts in terms of psychology, not just, candlesticks on our screen, right? Think in terms of other traders. We have a big consolidation area here. And really, the market likes to move from one consolidation area to another consolidation area. If you zoom out on your charts, especially if you go to like an hourly, maybe a 4-hour chart, it's probably easier to see this. But if you zoom out, you'll see there's consolidation areas everywhere, and then you have moves between those consolidation areas. So if you kind of break the market up into those chunks, in other words, supply and demand zones, you can better understand, the psychology behind it. Because if we do see a move back up into the 3,900, maybe even 3,950, think about all the traders who bought up here in this consolidation area looking for a breakout, okay? If they didn't stop out, they're underwater down here. They're in pain, right? So if they get the gift of some kind of a rally back up into their average, back up into this consolidation area here, what do you think they're going to do? They're going to probably sell, right? And as a buyer, would you feel comfortable buying right up against the bottom side of all of this supply? Heck no, you wouldn't, right? Why would you buy right underneath of resistance and significant supply? So you just got to think in terms of the psychology and the traders involved to kind of help you visualize the chart patterns, okay? So it's not just candlesticks on your screen. Just always try to remember that. So again, that's kind of what I'm looking at, guys. I mean, we're sitting right at that 50% of the gap fill. I think this is a pretty good spot to see a little bit of consolidation here, maybe a bit of a relief rally back up into that 3864 gap. If we can get along, off this 3800 here, this is actually a big put wall. In other words, there's a lot of open put interest here at that 3800. So that's going to be pretty heavily defended. So it should provide at least some good short-term support this week. And if we get a good long setup off of that, I wouldn't be surprised at all to see a move back up to 3864. Again, right up into that gap. I would probably take off the majority of my position there, if not everything. And then, if you do hold a piece, maybe we can get that move up into 3,900 area. Otherwise, if we break over and confirm, you might get a secondary entry over that for the long up into the 3,900 area. That's how I would personally play that. Otherwise, if we do see the move up into the gap here, whether you're long or not, and we start rejecting off of that, that's probably going to be a good spot to get another short on. To see if we can't get the move down to 3761. However, if the weakness continues and we just don't see anything in terms of buyers or, really any interest in consolidating it here or seeing a bit of a relief rally, and we do start seeing prices confirming below that 3,800. As I said, that's a big put wall of support there. It's going to bring in that forced selling that I was talking about, right? The dealers are going to have to start hedging to the downside. They're going to have to start selling stocks, and that should accelerate the move, or at least help us see the move down to the 37.61. So 3,800 is going to be key tomorrow and really for the rest of this week. I would expect it to hold, but I'm not necessarily going to hold a bias. I just want to let price action dictate that. So looking for a possible long off that 3,800 area again, as I said, up to 38.64, and then maybe a short entry there if we reject, or continue to hold the long over 38.64 to 3,900, and 39.51 would really be the drool zone in terms of a target for the long, and then possibly a short entry there. So we'll assess that as we get there, but as I said, that's kind of what I'm looking at here on the S&P 500. Now, the NASDAQ has been a lot weaker throughout this bear market, and you can see that today it was actually a leader in terms of the weakness. It definitely, a lot of the tech names that I saw were selling off considerably, so that kind of helped drag down the S&P 500 further today as well. As long as the yields continue to climb with the Fed, raising interest rates, it's going to continue to weigh on equities. That's the bottom line. If we zoom out on the yields here, this is the 10-year yields, but you can look at the 20 and the 30, very similar picture. They've been in a constant downtrend really since back in the 80s when we had significant inflation, the last time we had any significant inflation. So this big downtrend here has been broken, or it's breaking out from this downtrend as we speak, right? So if this breakout here to the upside in the yields continues, you can see that we have a long ways that we could go. Now, I'm not saying we're necessarily going to get back up here to 15% on the yields, but hey, anything's possible. The point being that the correlation still remains very tight between the yields and equities. And I think until the yields can really kind of find a top here, it's going to be really tough for the market overall to find a bottom. So just kind of keep that in mind. Kind of keep the yields on a side monitor or something. It's good to know what the yields are doing, because that can definitely play a part on whether we get any kind of a rally in stocks in the S&P 500, as I was saying. And then I guess one of the last things that I would cover here is just take a quick look at the VIX. Looking at the weekly chart on the VIX, we've fallen down from this 32 level here. We're kind of hovering around 22.5. One thing that I would mention in case you're not aware, the VIX is not a direct inverse of the S&P 500. So in other words, if the S&P 500 is selling off, right, it does not mean that the VIX has to go higher. Okay, it does not mean that at all. What the VIX is telling us essentially is how many people are buying puts on the S&P 500 index. Okay, so when a lot of people are buying puts, in other words, what puts are used for are to insure people's portfolios. Of course, we know we can trade puts, but they're heavily used, or they're really intended, I should say, to be used to insure your portfolio, right? You buy a put to protect your portfolio to the downside. The put gains value if stocks sell off, and that kind of offsets the losses in your portfolio. Well, if we don't have a lot of people buying puts, then the VIX is simply not going to go higher. We can have people selling stocks, kind of taking profits, maybe realizing some losses as we go into the end of the year for capital gains, right? For their taxes, right? It's not uncommon to see a lot of people kind of selling losers in terms of their stock picks for the year as we move into the end of December here, and just taking profits in general. You can have people selling stocks and not buying puts, which would see, downside pressure on the market, but the VIX would not be coming up as a result because they're just not buying the puts. Okay, so just keep that in mind. Now, if we do start to see the VIX climbing back up, and especially we start getting over that 25 level, it's kind of like 25 is kind of like a key number for me. When we start seeing the VIX getting above 25, that's getting to more elevated levels that I really want to be paying attention to what the VIX is doing. Of course, 32 is a big level. You can see how often we come up and test that level. 40 it's not often we get up to 40, right? So it takes a lot of put buying to get us up to those levels. So my point is that so far the sell-off has been pretty orderly. We're not seeing, big moves up in the VIX, which tells me that there's just not a lot of put buying going on, but it doesn't mean that that won't change, okay? It's just something that we, of course, monitor day by day. So that's about it, guys. That's kind of what I'm looking at. Again, don't be surprised to see a little bit of a consolidation here, maybe a bit of a relief rally as we move into tomorrow and perhaps, midweek. But if we see that weakness continue and we just don't get the consolidation, and you can see that, so far it's been a beautiful trend to the downside. I mean, a few little bounces here and there, but we haven't even consolidated yet since we've started this downtrend from the FOMC gap down. So, we could just continue all the way to the gap fill before we even try to consolidate and bounce. So just keep that in mind. Don't hold a bias. Let's take it day by day. Let's see how we open up tomorrow and what kind of price action we get, realizing that we're kind of sitting right about 50% of the gap fill. All right, guys, thanks a lot for watching as always. I do appreciate it. Hope you're doing well. Take care. We'll see you in the next video.